Welcome to Deloitte's Debriefs tax webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled Tax Collection at Source in India. The conundrum continues. My name is Pooja Dhokad and I am a tax senior manager based in Deloitte, India. I have the pleasure of hosting today's webcast. I have two speakers with me today, Jimit Shah and Samir Manyar. Jimit is a tax partner and Samir is an executive director. They are all based in Deloitte, India. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CP certificate after watching for 50 minutes. Now let me give you an overview of the topics we will discuss today. First, we will walk you through the regulatory framework governing overseas remittances from India and an overview of the Liberalized Remittance Scheme under the Indian Exchange Control Regulations. After that, we will discuss the framework of the tax collection at source provisions, which were introduced under the Domestic Tax Law of India, which shall include an overview of the provisions, the intent of introducing these provisions, what has been the journey so far, the summary of the rates and the applicable threshold, and the key clarifications issued by the Indian government. Thereafter, we will discuss the key considerations of the TCS provisions for various sectors and stakeholders. This will be followed by key takeaways and the question and answer session at the end of the session. We hope that you find the session interesting. I will now hand over to Samir to take this forward.
Thanks, Pooja. Hello, everyone. I'm Samir Manyar, and thanks for joining this session. I would like to kick off today's discussion with the regulatory framework governing overseas remittance from India. Overseas remittances by residents in India are divided into two types of transactions, which are capital account transactions and current account transactions. Capital account transactions are the transaction which alters the assets or liabilities outside India of the person resident in India and includes contingent liabilities or which alters the assets or liabilities in India of person resident outside India. This mainly includes transactions like investment by residents in foreign securities, purchase of an insurance policy from a foreign insurance company, loan by a person resident in India, guarantee issued by a person resident in India in favor of a person resident outside India, and acquisition of immovable property out there by a person resident. On the other hand, current account transactions are the transactions which are not capital account transactions and mainly includes payments due in connection to foreign trade like imports of goods or services, other business purposes like security deposit, short-term banking facilities in the ordinary course of business like overdrafts, payments due as interest on overseas loan and income from investments like dividend payments, remittance for living expenses of parents, spouse, children residing abroad, expenses in connection with foreign travel, education, and medical care of parents, spouse, and children under the Liberalized Remittance Scheme. We will now move on to the next topic, which is the Liberalized Remittance Scheme. Next slide, please. Liberalized Remittance Scheme is a scheme which was introduced by the government way back in 2004 for residents in India to remit money overseas for various purposes. This scheme is not available to corporates, partnership firms, HUF, trust, etc. The initial limit of the remittance under the Liberalized Remittance Scheme was USD 25,000 per financial year, which is April to March, which has been increased over the years to USD 250,000 per financial year. Under this scheme, all resident individuals, including minors, are allowed to freely remit up to USD 250,000 per financial year for any permissible current or capital account transactions or a combination of both. Remittance in excess of the above limit requires prior approval of the Reserve Bank of India, which is the Central Bank of India. Hence, a resident individual can remit up to USD 250,000 per financial year for any permitted transactions under the Liberalized Remittance Scheme. The permitted transactions under the Liberalized Remittance Scheme includes gift or donation, expenses for going abroad for employment, vacation or private visits other than Nepal and Bhutan, irrespective of the number of visits undertaken during the year, expenses for immigration purposes, medical treatment abroad, maintenance of any close relatives abroad, business travel and for attending any international conferences, seminar, specialized training, apprenticeship training, etc., studies abroad, or acquisition of overseas securities. So these are some of the permitted transactions for which remittance up to USD $250,000 is allowed under the Liberalized Remittance Scheme for resident individuals in India. However, remittance towards immigration, overseas medical treatment, and studies are allowed in excess of the prescribed limits, subject to verification and bona fide of the transactions by the authorized dealer bank in India. So, say if an employee is being deputed by an India entity for business visits abroad and the expenses are borne by the India entity, such expenses shall be treated as a residual current account transaction outside the Liberalized Remittance Scheme and will be permitted by the authorized dealer bank in India without any limit, subject to verifying the bona fide of the transactions. Further, resident individual who has remitted funds under the Liberalized Remittance Scheme can either retain and reinvest the income earned from his investment made under the Liberalized Remittance Scheme abroad. However, the received, realized, unspent, unused foreign exchange, unless reinvested, shall be repatriated and surrendered to authorized dealer bank within a period of 180 days from the date of such receipt, realization, purchase, acquisition, or date of return to India as the case may be. Next slide, please. The remittance facility under the LRS scheme is not available for certain purposes, which mainly includes remittance for any purposes specifically prohibited under the foreign exchange laws, like purchase of lottery tickets, sweepstakes, proscribed magazines, etc. Remittance from India for margins or margin calls to overseas exchanges, overseas counterparty. Remittance for purchase of FCCB issued by Indian companies in the overseas secondary market. Remittance for trading in foreign exchange abroad, capital account remittances directly or indirectly to countries identified by the Financial Action Task Force as non-cooperative countries and territories from time to time. Remittance directly or indirectly to those individuals and entities identified as posing significant risk of committing acts of terrorism, as advised separately by the Reserve Bank to the Indian banks, or gifting by a person resident to another resident in foreign currency for the credit of the latter's foreign currency account held abroad under the LRS. So generally authorized dealer bank in India may undertake the remittance transactions without RBI permission for all residual current account transactions, which are not prohibited or restricted transactions as per law. An authorized dealer bank is satisfied about the genuineness of the transactions for LRS transactions. Next slide, please. As far as the remittance under the LRS scheme is concerned, there has been steady increase in the last 3 years based on the recent statistics released by the Reserve Bank of India. As you can see on the left side of your screen, there was a steady increase in the remittance until 2019-20, after which there was a decline. This decline was mainly due to the impact of COVID-19 pandemic, which had a global impact in financial year 2021. However, after the COVID era, the remittance has again started flowing again significantly. In financial year 22-23, the remittance have increased to USD 27,141 million. As per the statistics released by RBI, the remittance have increased significantly in the post-COVID era broadly in the areas of travel, which has significantly increased in financial year 22-23 compared to financial year 18-19. The LRS remittance for maintenance of close relatives, gifts, Studies abroad and other expenses have also increased in the recent years. International travel accounts for majority of the outward remittance by Indians. This is followed by maintenance of close relatives abroad and further by gifts and expenses for studies abroad. Pooja will now take us through the rest of the topics regarding the taxes on remittance under the LRS scheme, clarification issued by the tax department, issues faced by the industries and others. Over to you, Pooja.
Thank you, Samir. Next slide, please. So let me now give you an overview of the TCS provisions, which are the tax collection at source provisions introduced under the Domestic Tax Law of India. Now, in February 2020, the Finance Minister of India expanded the scope of the TCS provisions and made it applicable to the payments made under the Liberalized Remittance Scheme, which is commonly called the LRS payments, and on the sale of overseas tour program package, which was effective from 1st October 2020. Now, if we see this, TCS is not a charging provision, it's not an additional tax, and it is creditable against any other tax liability, such as advance tax or a self-assessment tax. If there is no other tax liability, then a refund can be claimed of such TCS amount, and additionally, an interest of 6% per annum shall also be granted on such refund. Some of the other features of this levy are that one cannot apply for a lower or a nil rate of TCS. Unlike we have seen for other provisions like tax deduction at source, wherein a lower or nil TDS rate can be applied for. Also, a higher TCS rate will apply if the collectee's permanent account number, which is the Indian tax registration number, is not provided or it is incorrect. And also if the collectee has not filed its Indian income tax return for the last or the preceding financial year, preceding the year in which the TCS is to be collected. Now let us see what was the intent of the legislature to expand the provisions of the TCS to LRS payments as well as to sale of overseas tour package. Now the objective that was stated by the Indian government while introducing these provisions was to deepen and widen the tax net. So the government believed that as compared to the increase in overseas remittances, the corresponding number of taxpayers filing the Indian income tax return has not substantially increased. Also, there were instances that came to notice where the LRS payments are disproportionately high when compared to the disclosed incomes in the income tax return, as we also saw the statistics in the previous slides that Samir discussed. So alongside, there could be some other factors also, which is not really stated by the government, which could be preventing the depletion of India's foreign reserves, promoting the tourism and spending within India. So we believe that to plug all of this, the TCS provisions on LRS payments and the overseas tour package was introduced. Now, if these provisions are not complied with, there could be certain adverse consequences, which could include interest at the rate of 1% per month for delay in collection or depositing of the taxes collected at source. There could be penalties for failure to collect the TCS, failure to furnish the TCS returns, which is a quarterly TCS return that needs to be filed, and failure to issue TCS certificates. There could also be prosecution on failure to deposit the taxes collected. Next slide, please. So this brings us to our first polling question. As you see on your screen, to what extent the TCS provisions impact you and whether you are complying with the said provisions? The options are there is a significant impact and compliance is also done. Second option, there is a significant impact but the compliance is not yet done. Or there is an insignificant impact and compliance is done. Or there is insignificant impact but compliance is not done. Or there is no impact. Participants can choose the relevant options. So while we await the polling results, Samir, I had a question for you. If a resident has exhausted its LRS limits in a financial year and say repatriated back certain amount which is already invested under LRS, whether that repatriated amount can be considered towards LRS limits for any future or further overseas remittances?
No, once a remittance is made for an amount up to USD 250,000 during the financial year, a resident individual would not be eligible to make any further remittance under this scheme, even if the proceeds of the investments have been brought back into India.
So we can see the polling results now on our screen, wherein 36% of the participants have chosen the first option, that there is a significant impact on them and they are also undertaking the compliances, which is a good thing. While there's 20% of the audience where the significant impact is not there and the compliances are being undertaken. Only 10% and 5% people have kind of chosen that the compliances are not being undertaken. Okay, we can move on to the next slide. So now let us see how has the journey been so far on the TCS provisions. So as we discussed, the TCS provisions on LRS payments and overseas tour package was introduced in 2020. Now at that point in time, the TCS rate which was applicable was 5% on the LRS payments, exceeding an amount of INR 700,000, which is roughly approx 8,400 US dollars. The 0.5% rate was applicable on remittances for higher education loan from a financial institution, and a 5% rate was applicable on overseas tour program package without any threshold. Thereafter, in 2022, the government clarified that non-residents not having a taxable presence in the form of a permanent establishment in India shall be excluded from the applicability of these TCS provisions. And rightly so, as that would be against the intended objective. Then in 2023, we saw a slew of developments. At first, the finance minister in the Finance Act 2023 removed the threshold of INR 700,000 on LRS payments, and at the same time increased the TCS rates from 5% to 20%. The threshold removal and the increase in the TCS rates was not made applicable for remittances for medical and education purpose. Thereafter, on 16th May 2023, the Ministry of Finance issued a notification wherein the exemption from applicability of the LRS provisions to payments outside India using international credit cards was omitted under the Indian Exchange Control Regulations. Now, this was done to address the disparity in the differential treatment between debit cards and credit cards. While payments through debit cards have been treated as LRS, whereas payments through international credit cards outside India were not treated as LRS. And the data that was collected from the top money remitters under the LRS revealed that the international credit cards were being issued in excess of the present LRS limits of 250,000 US dollars. Hence, this notification was issued to bring in that parity and for prudent foreign exchange management. Now, the threshold removal by the finance minister in the Finance Act 2023 raised a lot of concerns about applicability of TCS even to smaller transactions. Thus, to avoid this procedural ambiguity, the Ministry of Finance, by notification dated 19th May, reintroduced the threshold of INR 700,000 per financial year for the payments made by an individual using international debit or credit card. Thereafter, the Ministry of Finance also issued a press release on 28th of June 2023 based on various suggestions and comments received from various stakeholders. Now, in this press release, what they did is that firstly, they deferred the applicability of the TCS rates, which were increased from 5% to 20% from 1st of July to 1st of October. They also continued the exemption from applicability of the LRS provisions to international credit card payments outside India. This was done to give adequate time to banks and card networks to put the requisite IT-based solutions in place. The ministry also introduced a threshold of INR 700,000 for payments towards overseas tour package. So this was the first time the threshold got introduced even for the overseas tour package, wherein a 5% TCS rate will apply on the first payments of up till INR 700,000, and thereafter a higher TCS rate of 20% shall apply. And it restored the threshold of INR 700,000 on all LRS payments through all modes of payment, not only restricted to debit or credit cards. In addition to this, to remove difficulties, certain clarifications were issued by the Central Board of Direct Taxes on June 30th, 2023, which we will discuss in the subsequent slides. Moving on, we have now summarized the applicable TCS rates and the thresholds on different categories of payments for the period before 1st October and after 1st October 2023. So if we see the table, for remittances under LRS for education purpose, where it is financed by a loan from financial institution, the rates and the threshold before and after 1st October remains the same. So there is no TCS up to INR 700,000, and thereafter it's 0.5%, which is a very low rate. On all the other remittances under LRS for medical treatment and education purpose, which is not financed by a loan, again, the threshold and the TCS rates remains the same before and after 1st October. So no TCS up to INR 700,000, and thereafter it is 5%. And for any other LRS payments which are made before 1st October, the threshold applied of INR 700,000, and after that a 5% TCS rate, which after 1st October has increased to 20%. And the remittances for overseas tour package program, earlier before 1st October, a 5% TCS rate was applicable without any threshold. And after 1st October, the 5% TCS rate will apply up to INR 700,000, and thereafter a 20% rate. Now, as we see, the obligation to collect and discharge the TCS for the first three types of payments are on the authorized dealer. Whereas for the remittances for overseas tour package, the obligation is on the seller of the overseas tour package. I will now hand over to Jimit to walk you through the key clarifications issued by the Central Board of Direct Taxes. Over to you, Jimit.
Sure, thank you, Pooja. So let us now delve into the essential clarifications issued by CBDT via circular dated 30th June 2023. These clarifications shed light on a few critical aspects. Firstly, CBDT has clarified that INR 700,000 threshold is applicable qua the remitter. Given that authorized dealers lack a centralized system to track all LRS payments by an individual, the responsibility for any inaccuracies or false information in the declaration or the undertaking lies with the remitter. So authorized dealers and sellers of overseas tour packages should place reliance on the undertakings and the declarations provided by the remitter. This means that the authorized dealers and the sellers of tour package program will not be treated as assessees in default if they correctly collect TCS based on the declarations and undertaking furnished by the remitter. Importantly, CBDT has also clarified that the thresholds for LRS and overseas tour packages operate independently. Specifically for LRS, there is no TCS below INR 700,000, while a 20% TCS applies for amounts above INR 700,000 remitted after 1st October 2023. In contrast, for the purchase of overseas tour package program, there is a TCS of 5% below INR 700,000 and 20% above INR 700,000. Despite the separate threshold for tour packages from a TCS collection perspective, they will still be reported as LRS payments by authorized dealers for exchange control purposes. Next, the CBDT has clarified the meaning of overseas tour package, indicating that it should comprise of at least two of the following components: international travel ticket, hotel accommodation, boarding, lodging, and or any other expense of a similar nature. This clarification eliminates ambiguity regarding whether standalone hotel or airline bookings can be considered a tour package, providing much needed clarity for tour operators and travel agents. As regard remittances for medical and education purposes is concerned, CBDT has outlined the nature of expenses to be included. For medical treatment remittances, it includes purchasing tickets for the patients and their attendant, medical expenses, and other day-to-day expenses related to the treatment. In the case of education, it encompasses purchasing tickets for the students studying overseas, tuition and other fees to be paid to the educational institution, and other day-to-day expenses for educational purposes. Before we proceed further, I would like to pass the floor to Pooja to engage our audience with a polling question. Over to you, Pooja.
Thank you, Jimit. So this brings us to the second polling question for the day. And the question is whether your systems and processes are in place to comply with the LRS and TCS provisions. The options are yes, somewhat or not completely, no, the processes are not yet in place, or it's not applicable. So while we await for the polling results, Jimmy, do you believe the TCS incidence on overseas tour package, which could be as high as 20%, could be mitigated in any manner?
Yeah, so that's a tricky one. Ideally, yes, if the accommodation and airline bookings are separately done and not as a package, and if the payment is within the threshold of INR 700,000, then the TCS implication shall not arise. Similarly, if a group is traveling, then different bookings can be done by different group members to take benefit of INR 700,000 threshold available to each individual. Hope that answers your question, Pooja.
Thanks, Jimmy. So we can see the results on the screen where almost 32% or 33% of the participants have mentioned that the processes or the systems are not yet in place or somewhat in place and not yet completely in place. So it will be important to put the processes and systems in place, while 25% have already put the systems and processes in place. So moving on, we can now discuss the provisions of TCS has impacted, kind of some key sectors and key stakeholders. Next slide, please. So as we see, the key sectors that are impacted by these provisions are hospitality and travel, education, and financial service. And the key stakeholders that have been impacted are the Indian businesses and the individuals resident in India. So we will now discuss some of the key considerations in interpreting and implementing the TCS provisions for these sectors and stakeholders. Moving on to the next slide. The most impacted sector has been the hospitality and travel industry. The industry is still grappling in practically implementing the TCS provisions and being compliant. So there are few tour operators and travel agents that have started collecting the Indian tax registration number, which is the permanent account number of the customers who are making the bookings on their platforms, and also complying with the TCS provisions. While there are some and few tour operators, travel agents that have not yet started these processes. So let us hear from Jimit on some of these key considerations which are relevant for this industry, such as who qualifies as a buyer, what about the historical remittances where the permanent account number of the customers have not been sought at the time of bookings, what are the critical aspects that one needs to keep in mind, and the applicability of TCS provisions on certain specific transactions for this industry. Over to you, Jimit.
Thank you, Pooja. So, as Pooja pointed out, while we navigate the challenging terrain of the hospitality and travel sector, we encounter various complexities when it comes to applicability of TCS provisions. Let's discuss a pertinent issue of who qualifies as a buyer. Let's discuss this with an example. For instance, consider this scenario. Booking is made by Mr. X through his profile on a tour operator's platform. The traveler is Mrs. X and the payment is made using Mr. Y's international credit card. The question arises, who should qualify as the buyer here and whose PAN should be obtained for LRS and TCS purposes. The complexity stems from the fact that the term buyer lacks a specific definition under the TCS provisions. Given the intent behind these provisions, one could argue that Mr. Y's PAN should be provided since he is making the payment. However, we have observed that different tour operators take different positions. Some seek the PAN of the lead passenger, in this case Mrs. X, while others request the PAN of the person making the payment, that is Mr. Y in our example. Some tour operators have also asked for the PAN of the person making the booking and agreeing to the platform's terms and conditions, which essentially means Mr. X in our example. So this makes it crucial for the tour operators and travel agents to analyze this issue and update their platforms to seek the PAN of the correct individual. Not only this, it is also imperative to note that this decision will also impact the LRS limits of the respective individuals. Another aspect that merits consideration is the matter of remittances to be made from India for the past period between October 1, 2020 and when tour operators or travel agents began collecting customers' PAN information. In our experience, authorized dealers have withheld remittances until TCS compliance were in place from October 1, 2020. Especially when customer PAN details were not obtained, tour operators and travel agents are burdened with a 5% TCS obligation regardless of INR 700,000 threshold. Furthermore, this situation creates practical challenge because authorized dealers cannot report payments against customer PAN for LRS reporting. In light of this, a one-time approval from Reserve Bank of India, being the Central Bank of India and the Indian Exchange Control Regulator, may be necessary to facilitate remittances from India. To our knowledge, RBI has granted such approvals in a few cases. Now, as we move forward, let's explore critical aspects that must be implemented to comply with TCS provisions. First and foremost, tour operators must seek declarations from the customers, which could be a check the box declaration on the platform to confirm if the customer exceeds the INR 700,000 threshold, including the current booking. The frequency of declaration collection is also a consideration. Ideally, such declaration is required for each booking. Tour operators and travel agents must update their systems and processes to ensure these declarations are appropriately sought and disclosed. Furthermore, tour operators who have absorbed the TCS cost will need to reassess the impact on their business, especially considering the increased TCS rate from 5% to 20% effective from 1st of October 2023. Further, appropriate mechanism will have to be put in place in cases where multiple agents are involved in a booking to comply with the TCS provisions. Another area where we await some clarity is the applicability of TCS on standalone airline bookings. So there have been speculations on whether standalone airline bookings qualify as LRS payments in different situations, such as bookings with Indian or foreign airlines, differing points of origin and destination, either or both being in India or outside India, and bookings through agents or directly or airline websites, among others. Additionally, in cases where tour operators merely facilitate the sale of a package and do not qualify as a seller, the obligation to collect and remit TCS may fall on the authorized dealer. Given that authorized dealers lack direct interaction with customers, they are passing the responsibility to collect the TCS and seek customer PAN data and declarations onto the tour operator or travel agent. Some authorized dealers are also seeking declarations from tour operators or travel agents to safeguard themselves from being considered as assessee in default. In a nutshell, while the CBDT has clarified some of the aspects, there are areas that require further clarity. Particularly, the hospitality and travel sector continues to face challenges, and it is essential for tour operators, travel agents, and authorized dealers to stay updated with the evolving regulations to ensure compliance. We can now move on to discuss the impact for the next sector. Over to you, Pooja.
Thank you for that insight, Jimmy. So now the next sector which is impacted by the TCS provisions is the education sector. So typically we have seen that scholarship payments are made by foreign institutes to Indian students and for pursuing educational courses in foreign universities. Students then remit the scholarship amount by way of fees to the foreign universities, which is covered under the LRS regime and therefore subject to TCS, at the rate of 5% if the amount exceeds INR 700,000. So, Jimit, what are your thoughts on the impact for this sector considering these scholarship payments?
Sure, Pooja. See, when it comes to scholarship payments, it is essential to first understand the mechanism of rewarding the scholarships. If the funds are directly adjusted against the university fees, the TCS provisions should not apply. However, if a student first receives a scholarship in India and subsequently remits the funds towards payment of university fees abroad, TCS regulations come into play. In such scenarios, it becomes imperative to restructure the arrangement to minimize the incidence of TCS. Also, appropriate declaration should be given by the students, including correct PAN and declaration of filing income tax return for last year, such that higher TCS rate of 10% does not apply. Does this clarify, Pooja?
Sure, Jimit, thanks. We can now move on to discuss the impact on the next sector, which is the financial service sector, which is particularly for the authorized dealers, given the obligation to collect and discharge the TCS on LRS payments is on the authorized dealers in India. So, Jimit, in your experience, how have the authorized dealers, reacted to these provisions? What are the steps they have taken or that should be taken by them such that they are compliant with these provisions?
Sure. So, as far as authorized dealers are concerned, implementation of TCS provisions present a challenge in terms of additional compliances. They are now responsible for collecting TCS at the correct rates and ensuring timely disbursement. Additionally, they must file TCS returns with accurate PAN information for the recipient to claim the credit of the appropriate TCS. It's worth noting that higher TCS rates will be enforced if the PAN is not disclosed or is provided incorrectly. Therefore, authorized dealers must establish procedures for PAN verification to determine and apply the correct TCS rates. Authorized dealers also face the task of LRS reporting and require a robust tracking system for payments covered under LRS. Challenges persist for historical periods where LRS reporting was lacking. To mitigate any potential exposure, comprehensive documentation and declarations are necessary since the common facility to track LRS payments across all authorized dealers is under development by the RBI. This declaration should include confirmation of whether the INR 700,000 threshold is exceeded and whether the individual filed income tax returns for the previous fiscal year. This will help in determination of the correct TCS rate. Furthermore, authorized dealers must assist tour operators and travel agents in obtaining RBI approval for past transactions where customers' PAN information was not collected. They must also evaluate the applicability of LRS provisions in various scenarios, such as payments to international credit card networks for foreign website purchases. To summarize, authorized dealers will have to establish processes and controls and update their systems to be able to appropriately comply with the TCS provisions. Over to you, Pooja.
Thanks for that insight, Jimit. We can now move on to the next impacted stakeholders, which has been the Indian businesses and the Indian resident individuals, particularly where payments are involved for management incentive plan and for business visits. Now, typically, we have seen that employees of Indian subsidiary of a multinational company or a group, being an Indian resident, can invest in the employee stock option or the employee benefit scheme issued by the overseas entity of the group. Now, in last year, in August 2022, the Indian exchange control regulations were amended, wherein the acquisition of less than 10% of the shares through such ESOP or employee benefit scheme by the Indian resident individual having no control was categorized as an overseas portfolio investment. It was also clarified in the regulations that such remittances made under the overseas portfolio investment scheme will be reckoned towards the LRS limit of such person. Although the applicable limit of $250,000 may not apply, however, it will be treated as an LRS payment. Now, the moment this is treated as an LRS payment, there could be TCS implications. So, given these regulatory amendments, Jimit, what impact do you foresee for the Indian businesses?
Right. So now for payments related to MIP, which is Management Incentive Plan, careful consideration must be given to TCS collection methods. So employees may opt for higher payroll deductions, which will preserve their invested corpus while reducing their take-home pay. Alternatively, they can choose no change in payroll deduction and thereby maintaining their take-home pay but decreasing the investment amount. On the other hand, employers may choose to bear the TCS burden or provide interest-free loans to employees to take care of the TCS. However, this may lead to potential perquisite taxation implications in the hands of the employee that may need to be factored. Indian entities as employers are obliged to upgrade their payroll systems, seek threshold declarations from employees, and collect TCS, ensuring proper compliance. They must reflect TCS collected in employee payslips and conduct awareness sessions to educate employees about considering ESOP payments as LRS for declarations. From Form OPI is a new reporting requirement for Indian employer entities. Regarding expatriates, the collection of TCS on remittances from India may lead to additional cash blockages, which can be mitigated through the restructuring of employee benefit scheme contributions. Let us now touch upon another important aspect relating to implications for Indian businesses concerning employee business visits. So turning our attention to the impact of payments related to business visits by employees, we find that Indian exchange control regulations stipulate that expenditure incurred for employee deputation overseas for purposes such as business visits, seminars, and conferences should not be classified under LRS. However, this exclusion is subject to rigorous scrutiny to ensure the legitimacy of the transaction. In our experience, payments made through corporate credit cards for these business visits are typically considered outside the purview of LRS by authorized dealers. This is contingent upon availability of appropriate documentation and declarations. Nevertheless, it is important to note that many corporations may not provide corporate credit cards to their employees. In such cases, employees may use personal cards for expenses which are later reimbursed by employer. Unfortunately, most authorized dealers are presently not extending the exclusion of these payments from LRS, even though they are incurred for legitimate business purposes. To address this, authorized dealers are encouraging the adoption of corporate credit cards to benefit from this exemption. On the other hand, corporations must also implement a robust corporate policy to ensure that these corporate credit cards are not used for personal purposes. Before we proceed further, I would like to invite Pooja to engage our audience with another interesting polling question.
Thanks, Jimmy. So this brings us to the third polling question for the day. What option has been chosen by you or your employees as regards collection of TCS on the employee's contribution to employee benefit schemes? The options are: the employees have opted for a no payroll deduction, or the employees have opted for a payroll deduction, or the employer has agreed to bear the TCS incidence, or there is an interim gap funding by the employer to the employees. And last option, that the no option is yet chosen by the employees. You may select the options on your screen. So while everyone is doing the polling and we await the results, Samir, do you believe that if the employees are not making any contributions under the management incentive plan, whether there can be still any implications from LRS and consequently the TCS perspective?
Yeah, Pooja, in the absence of any contribution by the employees for the management incentive plan, there shall not be any implications from the LRS and the TCS perspective. However, the Indian employer entity shall still be required to undertake the reporting compliances recently announced under the August 22 Indian Exchange Control Regulations in the form OPI.
Okay. So we now have the results wherein 31% of the audience has chosen that employees have opted for payroll deduction, which means it will reduce the take home pay for them. Whereas 8% have opted for no payroll deduction. And there's around 5% where the employer has agreed to bear the TCS incidence. Okay, moving on. Jimit will now walk us through the key takeaways on the slides that we have discussed today. Over to you, Jimit.
Sure. Thank you, Pooja. So now, as we draw our discussion to a close, it is evident that these provisions bring forth practical challenges, and there is a need for further clarity on certain aspects. However, it is imperative to note that the provisions are already in place, and a higher TCS rate of 20% is now applicable. Therefore, it is advisable for organizations to be in compliance, or if not already, to ensure they become compliant to avoid any adverse consequences. First and foremost, businesses should evaluate the applicability of LRS and TCS provisions. Simultaneously, they need to explore potential structuring options to mitigate the incidence of TCS to the extent possible. Some critical aspects to consider encompass the following. Firstly, upgrading systems and processes to align with LRS and TCS provisions, enabling the tracking of thresholds and the collection of appropriate declarations to ensure determination of the correct TCS rate. For instance, Indian entities as employers should update their payroll systems to capture TCS collected on MIP payments and request declarations from the employees. Similarly, tour operators and travel agents need to update their systems and processes to obtain necessary declarations from the customers and collect appropriate TCS on bookings. Second, the authorized dealers and the sellers of overseas tour program packages must maintain meticulous documentation to mitigate potential exposure in case of false declarations from buyers or customers. Thirdly, authorized dealers and sellers of overseas tour packages should establish robust controls and processes to validate the correctness and validity of the PAN details to ensure the collection of TCS at the appropriate rate. Next, even individuals should be well versed in identifying what qualifies as LRS payments when making personal remittances to provide accurate declarations to avoid any adverse consequences. Regarding tour operators and travel agents, it is vital to evaluate the necessity of seeking RBI approval for historical remittances where customer PAN details were not collected and provided to authorized dealers. Those continue to not collect PAN and TCS from customers should assess the impact on their business if they have to bear the TCS at the higher rate of 20%, including the deductibility of such grossed up TCS. In summary, businesses must undertake the necessary LRS and TCS compliances promptly to avoid any adverse consequences arising from non-compliance or delayed compliance. At an individual level, it is imperative to keep a vigilant eye on TCS credit and monitor thresholds for personal remittances. TCS credit can be verified through Form 26AS, annual information statements, and TCS certificates specifically issued in Form 27D. Correct purpose codes should be mentioned while making LRS remittances. For instance, the CBDT has provided clarity on purpose codes to be used for medical and educational related remittances. Now, while these are some of the key takeaways, it is crucial to recognize that as the provisions continue to evolve, businesses may encounter more challenges in the future that require thoughtful addressing. Also, in this evolving landscape, we will continue to monitor these issues, providing you with insights and guidance as the provisions and guidelines develop. Over to you, Pooja.
Thanks, Jimit, for that. So I think we can now open the floor for question and answers from the audience. We have about 10 minutes left. So, Jimmy, there is one question from the audience which states that the higher rate of TCS of 20% will lead to certain cash blockage for individuals. So, what steps can be taken by the government of India to mitigate this hardship for individuals?
Sure. In addressing the predicament posed by the higher 20% TCS rate, the Indian government could at least contemplate a linkage between TCS and TDS, particularly for salaried individuals. Now, this approach could involve employers seeking declarations from employees along with supporting documentary evidence such as Form 26AS. Subsequently, employers may withhold tax on the employees' salaries, thereby providing a mechanism to offset the impact of TCS, and therefore reduced TDS is then deducted while disbursing the salary to the employees.
Right. There's another question from the audience, and Samir, probably you can take up this one. That do you expect that the payments using the international credit cards outside India will be covered under the Liberalized Remittance Scheme in future?
Yeah, Pooja. So currently, banks and card networks do not have the IT systems in place to track the all the ICC credit card payments. So once the requisite IT systems and solutions are in place, we expect that the payments using international credit card while on a visit outside India will also be covered under the LRS limits to bring in parity between various modes of drawal of foreign exchange, like the use of debit card for overseas expenses while on travel, and to prevent by the bypassing of the LRS limits.
Okay. Another question that we have from the audience is that, Jimit, are there any possible ways to mitigate the TCS incidents on the students paying fees to the universities and foreign universities?
Sure. So to alleviate or to mitigate the TCS incidents for students covering university fees, there are a couple of considerable approaches, that we have been deliberating. Firstly, the institute granting scholarships can gross up the awarded amount to the account to account for the TCS. Subsequently, students can remit this grossed up sum to the foreign universities. Students in turn have the opportunity to claim the credit for the TCS and return the corresponding amount to the granting institute as a refund of grant. Having said that, here it is crucial to note that this may entail certain tax implications for the institute receiving the refund of the grant. Alternatively, a phase payment approach could be implemented such that students initially pay a portion of the fees, say 95%, and withhold the balance until they can successfully claim a refund of the TCS amount. This approach provides flexibility and allows students to manage their cash flows related to TCS more effectively. So yeah, at this stage, these are the two options that come to my mind, Pooja.
Sure. Thank you, Jimit, for that. So I think that's the Q&As that we had from the audience. And if there are any unanswered question and answers, then we will write back to you. So Jimit and Samir, thank you. And special thanks to all of you who were able to join us today. We would like to encourage you to fill out a short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the Dbriefs website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out to either to me or our speakers, Jimit and Samir. We'd be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the indirect tax on 24th of October, titled The EU Carbon Border Adjustment Mechanism Begins in October. Are you ready? At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.